Welcome to Finance to Fire, your source for clear, straightforward investment wisdom. I'm Jordie, the founder of Finance to Fire, and I'm thrilled you're here for this deep dive. The core purpose of this channel is to explain complex subjects simply. Having dyslexia myself, I found out a lot of investing content is often explained in difficult, jargon-heavy ways. I started Finance to Fire to cut through that complexity, because financial wisdom shouldn't require a finance degree. I hope my approach helps you grasp these concepts easily. Important disclaimer: before we begin, please remember that all content provided by Finance to Fire is for educational and informational purposes only. This is not financial or investment advice. Always consult with a qualified professional before making any investment decisions. Investing involves risk, and we make no guarantees regarding outcomes. If you find this podcast helpful, the best way to support the channel is to like this episode and subscribe wherever you listen to your podcasts. Now, sit back and enjoy.
Welcome back to the deep dive. Today, we are striking in for a bit of a historical journey. We're doing a deep dive into the 1978 Chairman's Letter from Berkshire Hathaway.
Right.
But forget the balance sheet, really. Our sources show this isn't just some dry financial report. It's more like a foundational masterclass in business philosophy.
Exactly. That's the mission today, isn't it? To kind of distill the timeless playbook here. This letter, it's nearly 50 years old now.
Incredible.
But it contains these absolute gold nuggets of disciplined thinking about investment, picking managers, and really crucially about business quality itself. It's kind of the definitive shortcut, to understanding the engine behind one of the world's most successful companies.
And interestingly, it was the sort of chaos of 1978 itself that almost forced this clarity, wasn't it?
Mm-hmm.
Buffett notes right at the start that the merger with diversified retailing and then fully consolidating blue chip accounts, it created an accounting monster.
Yeah, quite complex.
He had to restate figures, and he actually warned shareholders that grouping all these different businesses, textiles, insurance, candy, stamps together, it actually tended to obscure economic reality more than illuminate it.
Which is fascinating, right? Because even as he's wrestling with all this accounting complexity, he's basically shouting to his shareholders, look past the total number.
Right. Don't get lost in the weeds of the consolidation.
Exactly. If the big number hides what's really going on underneath the quality, or maybe lack of quality, in the different parts, then that top-line summary is, it's useless.
So if the accounting hides the truth, where does he tell us to look instead?
Well, that leads us straight into his core philosophy, doesn't it?
Yeah.
How to actually figure out what a business is worth.
Okay, let's unpack that central idea. The foundational lesson, and it's still, I think, the hardest one for most investors to actually follow, is simply ignoring the short-term market noise. He put it so clearly. Successfully forecasting short-term stock price movements is something we think neither we nor anyone else can do, just flat out.
It sounds so simple, doesn't it? Just ignore the noise. But the real challenge is, the emotional pressure, the institutional pressure maybe, to do something.
To act.
But if you genuinely accept you can't time the market, your whole focus has to shift, doesn't it? It shifts entirely to the intrinsic long-term fundamentals of the actual business underneath.
So the rule becomes?
Simple, really. Find excellent businesses, and then this is key, buy them only when they're available at attractive prices or, even bargain prices. The price you pay, ultimately, that's what determines your return.
And we see that discipline shown so perfectly in that comparison he makes about institutional money back then. There's this footnote that just perfectly captures the danger of chasing hype.
Oh, yeah, that footnote is quite telling.
Our sources point out that in 1971, markets soaring, prices are high, pension fund managers commit a record 122% of net funds to stocks.
Think about that number, 122%.
They were all in, borrowing to buy, basically, chasing that euphoria.
Imagine being that manager, committing borrowed money right at the peak. That is pure herd behavior. And then, what happens just 3 years later?
The flip side.
After the market tanks in 1974, they commit a record low of only 21%. They basically sold near the bottom because the fear was just as intense as the euphoria had been.
It's just astonishing, a perfect inverse indicator of where the actual value was.
Exactly. And Berkshire, they sat patiently during the whole boom, right? Waiting for the bargains they knew would eventually show up when everyone else capitulated.
So that patience isn't just sitting around doing nothing.
No, not at all. It's an active thing. It's a highly disciplined refusal to chase price or get caught up in the hype. And then, when the bargains did arrive, Buffett applied the concentration principle.
Ah, right. Not spreading bets thinly.
No. He didn't believe in just sprinkling a little bit of capital across, say, 50 ideas he felt only lukewarm about. He much preferred buying meaningful stakes in few great companies.
Yeah, his guidance there is pretty sharp. He says they try to avoid buying a little of this or that when we are only lukewarm.
Mm-hmm.
So the lesson really is focusing your capital, your best ideas, when you're truly convinced about the business and its price.
Okay, so if that's the process, discipline, concentration we need to talk about the subject,
Yeah.
what does this excellence he's looking for actually look like?
Right. The business selection criteria.
Exactly. What makes a business worth owning? He looked for businesses he can first understand. That seems obvious, but it's crucial.
Understandable, favorable long-term prospects.
Operated by honest and competent people, the management factor again, and of course available at a reasonable price. It always comes back to price.
And this focus on intrinsic value, regardless of what the market was doing day to day, it proved its worth pretty quickly for them.
Absolutely. The sources show that between 75 and 78, the businesses Berkshire owned in its stock portfolio, they significantly outperformed the Dow Jones average.
Even though the overall market was pretty much flat during that time.
Right. They essentially created their own returns because they were insulated by the quality of what they owned.
That structural advantage is so important. But what's just as instructive, maybe even more so, is looking at the flip side, the businesses he learned, often the hard way, to avoid.
Ah, yes, the cautionary tales. And he uses his own Berkshire Textiles business as the prime example, doesn't he?
He does. The textile plant, the equipment, it was carried on the books at a bargain cost. So, the depreciated value looked really low.
Looked cheap on paper.
Exactly. If you were just looking at the accounting value of the factory, it seemed like a steal. But the business itself, he said it had tough economic characteristics. Why was that bargain cost basically irrelevant?
Well, this is the crucial mechanism I think we need to grasp. The textile industry back then, it was just plagued by problems. Really low profit margins on sales.
Okay.
It needed huge amounts of capital just to keep running highly capital intensive.
Right.
And there was just chronic excess productive capacity.
Mhm.
Too many factories making too much stuff.
And those factors combine. How does that destroy returns?
Well, because there's always too much supply floating around, too many factories making fabric, the competition gets absolutely brutal.
So prices get driven down.
Right down. The market price for the finished goods, it tends to reflect only the direct operating costs. The cost of labor, raw materials.
It doesn't cover the cost of the factory itself.
Exactly. It completely fails to provide a decent return, or sometimes any return, on the massive amount of capital tied up in building and maintaining that huge factory. So the cheap assets on the books, totally meaningless because the business had zero pricing power.
So the lesson there is recognizing those industries where profits are just structurally capped. You have to avoid relying on luck or hoping the whole industry structure will magically change.
Precisely, because it probably won't. So if you manage to steer clear of those structural traps, the next layer of quality to look for is the human element, management.
Yes. Buffett constantly praised managers who didn't just work for the company, but, as he put it, think like owners.
Proprietary attitude.
And the 78 letter is just full of these wonderful, specific examples. He really highlights managers who are almost entirely focused on maximizing the return for shareholders through just operational excellence, not chasing headlines or anything.
Yeah, think about Gene Abeg. He was 81 years old, still running the Illinois National Bank.
Amazing.
And despite his age, running a community bank, his sheer competence and obsessive focus on cost control allowed him to triple the bank's net income.
Wow.
Or Ben Rosner, 75, at Associated Retail Stores. Retail was tough even then, but Rosner somehow maintained a stunning 20% after-tax return on capital. These weren't just lucky breaks.
Yeah.
These were sustained, extraordinary results, and they were driven by what Buffett called that almost passionately proprietary attitude toward the capital they were managing.
And that focus on management quality, it leads to a really interesting, maybe even counterintuitive lesson. Buffett realized that sometimes passive minority ownership, well, it can actually be better than having full active control.
Yes. The Safeco Corporation example is the absolute perfect illustration of this point. Berkshire owned, less than 1 million shares? just a minority stake.
Right, a fraction. But it was in what Buffett called the best-run large property and casualty insurance company in the United States.
So the obvious question jumps out, right? If it's the best, why didn't he just buy the whole thing? Take control. Isn't passive ownership risky if you can't steer the ship?
That seems like the logical move.
But that's where the discipline comes back in. Remember the price principle.
Yeah.
They paid substantially under book value for that minority stake.
Gotcha.
So they got the best company in the business for, less than 100 cents on the dollar. Meanwhile, he observed other corporations paying these huge premiums, way over book value, for mediocre companies, just so they could have control.
Paying up for the privilege of running it themselves.
Exactly. And his crucial insight, the quote that really nails it is, why should we wish to direct or even influence management policies of Safeco? The record would indicate that they do a better job of managing their operations than we could do ourselves.
That's just profound, isn't it? It's a massive check on the ego.
Totally.
The lesson is, focus on the quality of the business and its managers first. Control only becomes important if the management is mediocre or worse. If they're truly superior, just get out of their way.
And that ties directly into the final key point from the letter.
Yeah.
The value of retained earnings.
Right. Because Safeco's management was so good.
Mm-hmm.
The fact that they only paid out about 18% of their earnings as dividends wasn't seen as a negative by Berkshire.
No, not at all. That remaining 82% they kept, the retained earnings. Sure, Berkshire could have demanded it as cash, but Buffett argued it was just as real in terms of eventual benefit as the cash they actually received. Why?
Why indeed?
It connects right back to that management track record. If the managers are truly exceptional, like the Safeco team, they can take that retained capital, that 82%, and compound it inside the business at really attractive rates.
Rates that maybe Berkshire couldn't achieve elsewhere.
Probably couldn't, right? Rates that you, the shareholder, likely couldn't get if you just took the cash out and tried to invest it yourself. So how do you judge a company's decision to reinvest versus pay dividends?
Not by the size of the dividend check alone.
No. You judge it by management's historical record of using capital profitably. If they have a great record, trust them with the cash, let them reinvest it. If their record is mediocre, well, then you should probably demand the cash back so you can reinvest it yourself. It's the ultimate quality test.
Okay, so if we try to boil this down, the two major takeaways for you, the listener, today are probably, first, that disciplined patience. Waiting for truly attractive prices, refusing to chase hype, refusing to try and time the market.
Absolutely number one.
And second, this obsession with intrinsic business quality. Looking at both the structural advantages of the business itself and finding that owner-oriented, capital-savvy management.
Those are the core ingredients, really. The timeless playbook.
So let's close on that provocative thought, the one that kind of ties this whole 1978 letter together, reinforcing that idea of price versus control.
Yeah. Buffett noted back then that, quote, corporations are making very significant mistakes in purchasing entire businesses at prices prevailing in negotiated transactions. They were basically overpaying just to get control.
Right. While at the exact same time, he was busy buying small portions of such businesses at the greatly discounted valuations prevailing in the stock market.
The corporate world was paying a premium for control, while he was getting a discount for passive quality. Stark contrast.